Hello, 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 and happy Thursday. Welcome back to yet another live event where we unpack passive investing, multifamily underwriting, one step at a time. What passive investors must know about the capital stack and what is the capital stack? This is the topic that I will cover today based on popular demand. And for all of you who reached out privately as well as responded to the recent poll that I published on my social media, LinkedIn page, as well as other social media pages, thank you. I appreciate your suggestions. I appreciate your questions, and we'll make sure those get covered during these weekly pop up live events on LinkedIn and YouTube. But before we dive into today's topic, for those who perhaps may be tuning in for the first time, my name is Vessi Kapulian, former commercial lender turned real estate investor and entrepreneur. Today, I work with professionals in a couple of ways. In particular, with family enterprises, I work on the advisory side with private investors. I help both connect them to well vetted cash flowing investments in apartments or help them navigate through various due diligence aspects of the investment when it comes to the underwriting. And last but not least, for those willing to do a deeper dive and learn how to evaluate and underwrite a deal from beginning to end, I have additional resources, including a course and a community, and most recently, an Amazon bestseller, Mastering Multifamily Underwriting 5 Steps to Confident Risk Smart Apartment Investing. I will post the link to this newly launched book that I published in the comments below. And we're still during launch month, so grab your copy today before launch pricing expires next week. So, without further ado, let's dive into today's topic, which is discussing the capital stack. And I can talk about it, but a picture is worth 1,000 words. So, what I'll do is I'll share one here on the screen and we can follow along together. It is a question that I receive very frequently by investors. And actually, yesterday I was hosting an Ask Me Anything call, and the topic uh, kept surfacing as well. So it's a very important question to ask, very important question to understand. So for those who are curious about it, I really do appreciate you thinking about it. I appreciate you asking about it. So give me a moment. I will bring up the image in just a minute. And I think it will just help everyone follow along more closely. All right. So hopefully you guys can see that. I particularly like this image because it's very simple, very easy to understand, and clearly shows the trade-offs that you as investors, anyone as investor, myself included, we all need to be aware of. So this one is a little bit flipped, I guess, and I've seen it present both ways, but I'll start from the bottom and kind of work my way to the top. And in terms of seniority, you often hear the term senior debt. And that's typically the bank loan that is, in most cases, real estate properties are bought with a combination of debt and equity. Sometimes all cash deals, right? All equity. But in most cases, it's a combination of debt and equity. And the senior debt partner is typically at the top of the pyramid when it comes to priority in payment. So the lender will typically get paid first. Now, in terms of potential return, they of course charge an interest rate on the loan and they collect a certain amount of spread and fees. But relative to what the other layers of the capital stack can make, those are relatively low because presumably they're also taking the lowest amount of risk. They're still taking on risk, but relative to the other parts of the equity stack, it's lower. Then comes the mezzanine debt. Along those lines, you may also see a tranche of subordinated debt, maybe secondary liens, basically all other debt that is junior to the senior debt provider. So it is still debt. So after the lender, the senior lender gets paid first. Second in the stack in terms of payment priority would be the mezz debts. Secondly, in subordinated debt stack or partners. They do take on a little bit more risk, right, than the senior debt provider because they're second. And for that reason, it is customary and expected to see higher cost of capital there when it comes to interest rates and other fees. Then third is preferred equity. Now this is part of the equity stack, but it functions almost like quasi debt. And I'll spend a little bit more time on that segment. I'll come back to it in a moment. But typically, these are equity holders, so they have the opportunity to benefit from the upside of the deal up to a certain capped amount. And one of the benefits or what makes pref equity attractive for some investors or many investors is the fact that in most cases it is structured with a current pay portion, which is effectively, you can think of it as a coupon, right? As a preferred return that they get ahead of any other common equity holders. And in the current environment, that can be anywhere from 6 to 7 or 8%. And then the remainder of the upside, which is typically capped to 14 to 15%, they collect at the time of exit. So they take on a little bit more risk, right, relative to the debt providers, but assuming it's a strong cash flowing, well underwritten deal, the benefit for those types of investors coming into that tranche is a more predictable cash flow, more income opportunity, and less of an upside on the back end. And then at the bottom of the stack, in terms of priority, are the common equity holders or limited partners, investors. Now they have the highest potential for profitability and making gain on the investments if everything goes according to plan and if everything goes well. And that if component is key, right? Because to benefit from that highest potential upside, they also take on the most amount of risk. Because again, if things don't go as planned and things don't go as well, those other parties that in this particular pyramid rank at the bottom of the stack in terms of returns, they do rank higher in terms of priority. They'll get paid first, collect their principal first, and then there may or may not be anything left for the common equity holders to stockholders to collect. Now, I did mention preferred equity because I've seen it more and more in the past, call it 12 to 18 months. This is not a new phenomenon, but I don't think it's a secret that raising capital in the past, call it 24 months, has become more difficult and more difficult. There are also deals that have been in need of fresh capital infusion. And in those cases, I've seen situations where the lead sponsor may bring in a preferred equity partner to either help bring that fresh equity in order for them to perhaps refi and to for the lead sponsor to be able to refi the existing deal from a bridge to a more permanent financing, which again in the current environment is not going to happen without the owners injecting additional equity, additional fresh cash into the deal. And so that's where preferred equity partners may come in, or on the front end, right? If a sponsor is raising for a net new deal, Perhaps it's a relatively large raise, but a property that they like in the market that they like, that's going to do well. They've underwritten it, they've run the numbers, but they need additional capital. So that would be another situation that I see very frequently where the pref equity partner would be brought in. So a couple of points to be aware of. I often see, I don't want to use the word misrepresented, but maybe miscategorized. Oftentimes people would say, well, it's preferred equity, so it ranks higher than the common equity stockholders, which is correct. And because of that, you get paid first, and the risk is lower if everything goes right, and this and that. And yes, that's all correct. But if is a key component here, and where I have a lot of concerns is when that pref equity comes in, it's presented as rescue capital, really. And again, because they rank in the capital stack higher in terms of priority, doesn't necessarily mean it's safer. And in those situations, especially in the rescue situations, it's imperative to really understand what's caused, right? The various, what's causing the additional injection of capital. Is it purely refinance, or are there any other operational issues, any other market issues? How have those been handled or not? Really dig into the key principles, ability to operate and execute on the property. And then secondly, understand the exit, because I've seen deals or situations where again, pref equity is being brought in to rescue the deal, but there's some pretty aggressive exit assumptions. Again, cap rates and rent growth are two that come to mind, where the picture seems pretty rosy, and LPs are led to believe that if they approve, because very often that requires the addition of pref equity after the deal has closed. It requires approval from the limited partners. It's often painted as, hey, contribute to the capital call. We're also bringing in this partner, but if you don't, if you don't, you're going to lose your money. And I've seen situations where the exit assumptions are so optimistic, or rather unrealistic, that maybe the pref equity will do okay, maybe they'll be able to protect their principal, but the LPs are still getting wiped out. So then the question is, well, do you want to contribute to the capital call today in the hopes of maybe protecting it, or are you better off investing that money in another deal that will generate better returns, and that's has better risk mitigation relative to the situation you are evaluating today. Also, because they are taking on slightly more risk, right? They, especially in those distress situations, but in general, right? Depending on how that pref equity agreement is structured, there may be specific triggers that allow the pref equity partner to effectively step in and control the deal or force a sale, which sometimes it may or may not be in the best interests, right, of the common equity holders. It may or may not be in the interest of the rest of the GP team, but at the end of the day, it gives them the right to, because they typically come in with large seven-figure checks, right? It gives them the right to take the reins and the decision making over the property, especially if they feel that maybe it's not managed optimally. So you really want to understand who that group is, what their history is. Does it align right with the culture, the values, the investment philosophy of the key sponsors that you originally invested with? Because you may you may end up partnering with someone very different all of a sudden if those rights are triggered. And again, depending on how these agreements are structured, some tend to be more friendly, more relationship oriented, but others not so much. So there may be surprise in the middle of the deal if you don't fully understand how that is. And all I'm saying is, this is not right or wrong. All I'm saying is that make sure you ask those questions up front, so you can then make an informed decision of whether you're comfortable with that or not. And in a very similar manner, right, when we talk about debt, there's a ton of debt funds. Obviously, rates have been higher than where historically they've been trending, and so that's made debt investments particularly attractive. But what I, again, unfortunately see from a marketing standpoint, they're often described as very safe haven, right? You're guaranteed returns, you're clipping coupons. And yeah, that's, again, in theory, that could very well be true if everything goes right. But as a former lender, I will take you that there is a reason why banks take those loss allowances, right? Those loss reserves on their financials, because losses do happen. Companies do go through the stress. So just because you rank higher in the capital stack doesn't necessarily mean that you are precluded, or that your risk of loss is minimized. Of course, because you rank higher, especially if God forbid there is a distress situation and there is enough value in the collateral, maybe you get fully paid. Maybe you're still able to recover your principal fully, um, or at least partially, whereas the other parties in the capital stack will have a total loss, right? So from that perspective, yes, it's safer because you rank higher, but it's not entirely risk free. So things like clipping coupons and guaranteed and safe and protected doesn't don't particularly sit well with me, because I feel, especially for LPs who may not be as experienced, that may be slightly misleading. So it's an important distinction to make. So I know I talked a lot. I really appreciate you joining in live today. Let me know if the topic was helpful. This was one of the questions or comments rather made during the poll, and one of the requests was, hey, let's talk about this topic and help us understand what exactly that means. So hopefully you found this clarification helpful, and I do promise we'll cover the remaining topics that you guys inquired about. I very much look forward to that. And if you tuned in for the first time today, I usually pop up every Thursday, subject to holidays and travel schedule, typically anywhere between noon and 2 Pacific, so in the afternoon here, early evening East Coast time. And I cover a topic of interest, usually topics brought up by you, and or news that I find important, or topics that are perhaps a little bit more nuanced, that I feel are important to discuss and peel the onion on. And if you would like to take the next step in your underwriting journey, highly recommend my newly published book, The Mastering Multifamily Underwriting: 5 Steps to Confident, Risk Smart Apartment Investing. It was published last month, so you can still claim your copy at the very low launch pricing. And for those willing to do a deeper dive, you can DM me directly, and happy to have a discussion on how I can help you do that. And until then, I wish you a blessed Thursday, great weekend, and I'll see you next week.